Hi there, this is Dan Kerr's DK Analytics. Thank you very much for tuning in. It is Thursday, March 12th, 2020, early afternoon here in Southwest Florida. I'm chiming back in with the third video in a recent slew of videos, which I promise you is going to abate sharply. The topic that is causing me to do this is the bear market that is now in place in U.S. stocks. And my question, are Treasuries and the dollar next? And I think that is what is in the offing. Allow me one more video here prior to my corporate anorexia take, which I keep pushing out. But given this official bear market story, I thought I'd postpone it by one more. However, I can tie that topic, corporate anorexia, well into this current video, and also what ails us. And that's the real fly in the ointment, not the coronavirus, but what ails us. And that is debt, zero interest rate policies, and financial engineering over real engineering. For graphic flavor, consider stock buybacks over R&D and CapEx Boeing and its current plight. Will Boeing become America's new GE poster child of how to ruin a great franchise built over a century? Is this how America intends to reduce its annual trade deficit? And speaking of financial engineering, are you as sick as I am about all the glorified talk concerning the sophisticated Fed's tools and toolkit, as if it had laparoscopic tools, or as if it was a laparoscopic surgeon performing highly complex, minimally invasive, high value added economic surgery, whereas in reality it is essentially a clumsy, the Fed, a clumsy two-trick pony that always gets it wrong, and in so doing does nothing other than beat its interest rate and money printing club, or threaten to do so, in an effort to squelch price discovery, free market capitalism, sound allocations, and capital formation through its yield starvation policy run for the benefit of debtors, also known as ZIRP. Let me list a few intraday valuation metrics before continuing. The trade-weighted U.S. dollar stood at 116.9. It's starting to come under a bit of pressure. The U.S. 10-year Treasury the yield is up a bit. The bond is down a bit at 0.7% intraday here on March 12th. That might be a sign of creditors sniffing something isn't quite right. More on that later. The S&P 500 stood recently at 2581, getting a bit of a lift from the Fed promising more QE. Oil at $30.87 per blue barrel, more or less holding steady. And gold and silver have gotten hit today, down between 3 and 4.5%. Gold is recently traded at 1,590 per troy ounce, and silver at $16.02. I think there are liquidity issues, that is, investors and speculators in liquidity issues that have been pushing precious metals down. Remember, they're very narrow markets, especially silver. This is a blast from the past in terms of what happened in 2008 when the stock market came under substantial pressure in the fall. And I will review as to why I think this is going on and why I think this is a fleeting thing a bit further into the video. Again, the S&P is down over 20% from its early February all-time high. Other U.S. indices are off 20% or more. Therefore, we are now in an official bear market in U.S. stocks for the first time in ages. Next to airlines and shale shares, stocks, U.S. bank stocks, are getting killed. Leading names are down 30 to 40% or even more from a month ago. Nevertheless, bureaucrats continue to tout healthy bank balance sheets. So do the talking heads on financial news channels. Yet, just like in '08, almost everybody forgot to look at the increasingly speculative nature of their loan portfolios, of the ever more indebted entities they lent money to, thanks to central banks keeping interest rates artificially low. The shale oil debacle is only the tip of the iceberg of banks' bad loan portfolios. Recall that non-financial U.S. corporate debt, recently at $6.6 trillion, by itself nearly a third of U.S. GDP, is over $3 trillion higher than it was 12 years ago, back in the first quarter of '08. And zombie firms, those unable to pay principal repayments and interest expense from their cash flow, never mind their income, they are said to be at least 20% of all publicly listed firms in the U.S. On top of that, consider that total U.S. debt, including financial debt or intra-bank debt, which is increasingly suspect given the speculative allocation nature and the leverage often involved, think repo operations, has gone from the total U.S. debt has gone from $53.5 trillion in 2008 to $74.6 trillion in Q3 of 19, the latest figure that the Fed provides, which is a whopping $21.1 trillion increase, nearly representing the current size of the U.S. economy. Globally, debt is up some 115 trillion over the same time period since Q1 of 2008, while a broad measure of global central bank balance sheets, including smaller countries, has revealed approximately $25 trillion of growth, balance sheet growth since early '08. The bigger point, the domestic economies and the global economies' interest rate sensitivity is much higher as debt growth has exceeded GDP growth by roughly 3 to 1 by well over a decade. Yet, we have record low interest rates after a 39-year bond bull market juxtaposed against unparalleled global insolvency risks that can only be addressed by bankruptcy or yet more money printing, both of which should scare the living daylights out of creditors, which is precisely why I think we're going to see a belated wake-up call, that is, a return of long comatose bond vigilantes. For big picture flavor, consider this. 1 percentage point increase in average global borrowing costs, given roughly 260 trillion of global debt, would result in $2.6 trillion more interest expense for a global economy roughly 86 trillion in size as the existing debt was refinanced. Said differently, just a 1 percentage point increase in the cost of capital would constitute a 3% of global GDP higher interest expense. And interest rates would still be on the floor in much of the world. Now imagine what a return to normalized interest rates, to around 3.5% to 4% in the OECD world from currently zero-bound interest rates would mean. Imagine a reversion beyond the mean, which would be easily double that. Recall that the U.S. Treasury in the early 80s hit the 10-year at 15.7% yield, all right? If we imagine a reversion beyond the mean rate, which always happens in the boom-bust nature of markets driven by our mood and conviction swings. It's either a fine cigar or a stogie, right? Not to mention the pronounced insolvency and monetary inflation risks that we have today that we didn't have in '08 or in earlier periods. What I'm trying to say is that it's very possible that we overshoot strongly beyond a normalized interest rate. But let's stay with a return to normal interest rates as measured over 100 or so years. And let's say that with that as a starting point, we end up, because we're near the zero bound, with 3.5 to 4% higher interest rates. That is 3.5 to 4 percentage point higher interest rates. Well, the global economy's financing cost in such a world, just on existing outstanding debt, would increase by $10 trillion, or by 12% of current global GDP within a decade or so, as the old debt is refinanced at much higher rates, possibly within as little as 5 years. With that as framing, how much longer will we have an unprecedented bond bubble led by mostly bankrupt governments that are still able to borrow at either negative nominal rates of interest or negative real rates of interest? How much longer will creditors take their cue from central bank bond buying? In other words, when will they continue to ape central banks, expecting lower yields? How long until they start to sell bonds to central banks, which would quickly overwhelm our serial currency destroyers, our central banks, given the record outstanding debt, which is the central bank's progeny? If big bondholders or bond vigilantes do their math and take a look at what would happen to the value of their bond portfolio in such a world, they would run for the exits. That's my point. Meanwhile, the spreading coronavirus, now labeled a global pandemic by the WHO, continues to shut down more flights, more travel. Yesterday evening, President Trump announced a 30-day ban on travel to the US from Europe, shut down more conventions, the spreading virus, more schools, and more sports events. The NBA just suspended its games. In this regard, you may recall my frequently harping on the economic and freedom damage done by America's ambulance chasing lawyers. I'm going to tie this into the coronavirus. Domestically, America's out of control litigation situation, our litigious society's liability costs at 1.7% of GDP are a whopping 2.6 times higher than Europe's 0.63% of its GDP. This out-of-control litigation situation may well conspire to dramatically increase the economically smothering effects of coronavirus lockdown responses. This is not a rounding error. This is very significant. It's behavioral, and it could worsen the throttling that this entire behavior induces. For example, say colleges, schools, employers, event organizers, etc., decide it's better to shut down their enterprises rather than to be sued by a student, an employee, or an attendee that came down with a virus, and that such an occurrence can be tied into school, workplace, or event exposure. In the interim, globalized supply chains emanating from China's worldwide manufacturing hub, juxtaposed against just-in-time inventory practices and the generally low inventory levels that this has long spawned, threaten to progressively shut down more and more assembly lines because parts and components can't be procured and integrated into the finished product as previously stated. This will spike what has already been a rapidly weakening global manufacturing situation as per global PMI statistics, which increasingly showed growing weakness as of late 19 into early 20, that is, prior to the current coronavirus dilemma. In summary, we have unparalleled public and private sector debt. We have a services and manufacturing recession growing ever stronger. And we have politicians and bureaucrats running over indebted countries that are responding to our economic implosion with widespread and varied fiscal rescue packages and bailouts that will, of course, be financed by yet more money printing until confidence in fiat currencies is fully lost. Call it, if you will, Keynesianism, Keynesian monetarism, enabled cronyism, or other forms of wider redistributionism that are the antithesis of furthering survival of the fittest, much less advancing sound allocations, much less not throwing more good money after bad. Isn't this called socialism? And as usual, the U.S. is taking the fiscal spendthrift lead, which will be even more crass than usual given that it is an election year. And Trump can ill afford to go into the November election with a crashing economy and a crashing stock market because, as I've long said and we all know, at the end of the day, voters vote their wallets. Trouble is, Trump, who as a candidate called the stock market a big, fat, ugly bubble under Obama and Yellen, took ownership of an even bigger, fatter, and uglier bubble, proclaiming over and over that Americans' 401k plans, their pension plans, the vast majority of people, were rocketing higher and that the economy has never been so strong. If this comes unraveled together with an economy generating a growing number of pink slips that not even the fake unemployment rate offered by the government can whitewash, it won't be so easy for Trump to get reelected. Hello? A possibly $2 trillion to $3 trillion federal deficit in fiscal year 2020, as measured by growth in federal debt on top of America's $23.5 trillion in debt? Or, hello, a Fed expanding its balance sheet by a similar magnitude to pay for it all and to rescue its Wall Street crony owners from their leveraged speculations gone awry as foreign creditors that have extended America $10 trillion in net financing possibly start to get cold feet? Those cold feet could cause the Fed to soak up dollars coming home, adding to balance sheet bloat. Hello, a new bear market in the dollar to help spike our already rising CPI? Hello, President Biden, as too transparently red Bernie appears to be disappearing from the scene? Hello, rising tax rates and more regulations to save us from the free market capitalism that destroyed the economy, as the Democrats will proclaim? Never mind that we actually haven't had a free market economy in decades, but that won't matter to voters. But it will matter greatly to investors, at least at some point, and that's what I'm trying to say here. You know, details such as much weaker GDP growth, even lower earnings per share than would otherwise be the case, even less property right protections than the court are already on offer, even more debt, and even more money printing, not to mention more inflation? How can stocks and bonds keep from plummeting from bubble levels in such a world, which I think is going to be the stagflationary 1970s on steroids? How can physical gold and silver in dollar terms, in fiat currency terms, not rise in such a world? That is, once the scramble to sell liquid assets such as gold and silver subsides. That scramble, that same scramble in 2008 had precious metals decline about 30% or more prior to parting company with the stock market stoutly to the upside for years thereafter. I think that's going to recur. And in fact, precious metals, gold has been rising. It hasn't taken that big dive that happened in '08, and that is probably a very significant indicator. I've often mentioned that I think the S&P 500 index has downward potential in excess of 50%. In fact, I've mentioned 75% or more on a few occasions. And I stand by that, given the poor quality, financial engineering based, non organic growth in earnings per share that we've had, and how we've dug a deeper debt and misallocation hole for ourselves for decades, but especially since 2008, after which we doubled down on all of our mistakes, our toxic public policies too, and are about to do it again from a much weaker posture, and with arguably, at least in the US, even greater bubbles. Yet, there is a scenario in which stocks, of course in nominal terms, may do better than I think. Now, I want to draw this to your attention, at least until confidence in fiat currency is totally destroyed. How so? If the Fed and other central banks engage in unparalleled currency debasement and initially float the stock market while they inflate their currencies, that might happen. Translations? The translation would be your stocks go up, but your purchasing power may go down even more. It will go down even more. Therefore, the best way to measure how stocks will likely fare in our counterfeit currency world about to get even faker or more fake is to compare the value of stocks to gold, both priced in fiat currency terms, of course. I will use the Dow here because of the longer history and greater familiarity of that index instead of the more appropriate S&P 500 as the stock market, however imperfect. The long and short of it is this. I think we will be going from our current 13.7 troy ounces of gold required to buy the Dow stoutly in the direction of 1 troy ounce of gold to buy the Dow, as nearly happened in February 1980, when the world, and especially the US, was in much better financial shape but had higher inflation. And I might add in here as well that silver, gold's little brother, is going to be along for this ride, but I think in much stouter terms, given the fact that the silver to gold ratio has run up all the way to about 100, and that silver is actually positioned to possibly outleg gold 4-to-1, if not more, in the next stout precious metals bull market. Now, whether that Dow, which 1 troy ounce of gold, I'm guessing that we're going there, and I'm going to get back into it, from 13.7 troy ounces of gold to buy the Dow, I think we're going to have 1-to-1 parity. 1 troy ounce of gold will end up buying the Dow. And whether that Dow, which 1 troy ounce of gold will buy, is a Dow of 5,000, 10,000, or 21,500, close to the current Dow quote, is actually quite secondary from a gold owner's perspective because A, gold will preserve purchasing power as it has always done, and B, because the dollar value of gold could well rally threefold, a Dow of 5,600, sixfold, a Dow of 10,000, or 13.6-fold our current Dow valuation close to 21,500. Even if the Dow either goes down substantially or goes nowhere from here, the 21,500 mark, right? And if the Fed's electronic printing press manages to push the Dow to 43,000, a double from today's quote, the dollar price of gold in a one-to-one Dow to gold world would be 27 times higher than our current gold price, which would blow a Dow doubling from current levels into the weeds, doubling versus 27 times. Why do I think we're going to get closer to the early 80s one-to-one ratio of the Dow to gold instead of the early 33, January 33, 3-to-1 ratio? And I'll bring this onto a chart in a second. Because I think we will be closer to the stagflationary 70s on steroids, much greater excesses, than to the 30s depression because we lost the discipline of gold-backed money after 1971. Oh yes, and now that Dow to gold chart, here we go. This is courtesy of Macro Trends, a chart from Macro Trends. This is the 13.7. That is, it takes 13.7 troy ounces of gold to buy the Dow. I hope you can see my chicken scratch here. If you can't, I apologize. This is the early 80s where we had stagflation, stocks and bonds came under pressure, and it took only 1.3 troy ounces of gold to buy the gold. Again, that's where I think we're heading back in that direction. Oops, let me bring it over here. And back down here, that's at the bottom of the Great Depression in the 30s, February 33, I believe is the right date, January 33, I apologize, where we had the Dow just totally get collapsed, but we still had the discipline of sound money, all right? But I think we're going to go back here. And I wanted to clear that up and mention it briefly because I often state how vulnerable stocks are, and I needed to bring this on board in case the Fed and other central banks go absolutely insane. I hope you got something out of my musings for today. I'm going to sign off here with, this is Dan Kurz of DK Analytics. It is March 12th, 2020, and we are back in an official bear market in the US, which frankly I think is going to get quite a bit steeper. Bye-bye.